Hey, what's going on everyone? It's Griffin here, and if you follow my channel, then you would know that I actually own a fair share of physical real estate. I've been investing for around 4.5 years at this point, and it's an asset class that I've quickly fallen in love with for several wealth building characteristics. It allows for cash flows, appreciation, and debt paydown primarily as its means for building wealth long term, along with controlled leverage, which really brings returns to the next level if approached correctly. But of course, physical real estate is a lot more hands-on than other asset classes, specifically stocks. Nonetheless, though, a lot of retail investors still seek out that exposure to real estate, but might have mixed feelings about owning and managing rental properties, and this severely limits investment options. Investors could either choose to utilize crowd-funded real estate platforms such as Addy here in Canada, or say Fundrise down in the United States, or the most popular option for stock market investors that do still want that exposure to the real estate industry is by utilizing what's known as a real estate investment trust, or REIT for short. I've spoken a fair bit about real estate investment trust on the channel in the past, and I've also spoken about the fact that I've previously been a shareholder of RioCan and still currently am a shareholder of Granite REIT, mainly due to the fact that these are real estate investment trusts that own and operate types of real estate that I, as an individual retail investor, wouldn't be able to get exposure to, at least not yet in my career. Now, if you're new to the concept, an REIT is a type of company that owns and manages real estate as their primary source of income and main line of business. So essentially, REITs allow stock market investors to buy and sell shares of their company just like they would any other stock that trades on the stock exchange. The main difference, once again, is really just the fact that these types of companies own real property rather than, say, manufacturing iPhones. Now, one of the main advantages of REITs for income-seeking stock market investors is the fact that they generally have a higher than average dividend yield, along with a monthly dividend distribution schedule, really due to the nature of their requirements as an REIT. I won't get into the details about why this is, but this is why you can clearly see this with funds such as RioCan, Granite REIT, and Canadian Apartment Properties REIT with nice dividend yields. Of course, that's despite the fact that underlying asset values have lost a lot of momentum and value really since their peak in early 2022. Let's now speak about why that is. So while REITs hold physical real estate often in the hundreds of millions or even billions of dollars in assets under management, well, there's a difference between the asset equity that's held on an REIT's balance sheet and the market capitalization that the stock market is attributing to the company. For example, Granite REIT, that owns and operates industrial properties such as logistics centers and warehouses with clients such as Amazon, currently has a market capitalization of roughly $5 billion. That said, the company has roughly $9.5 billion in assets and $3.8 billion in liabilities, leaving stockholder equity of around $5.7 billion, and this will of course change depending on the REIT in question. In contrast to this, say Allied Properties, that's an REIT that owns and manages office buildings, has a market capitalization of around $3.3 billion, but stockholder equity of $6.6 billion. So in this case, the actual stock market is valuing the company significantly less than even just the equity that the company holds on their balance sheet. Basically, the point I'm trying to make here is that just like with any other company that trades on the stock market, well, a company's market capitalization over time and therefore dictating investor returns is a complicated mix between company performance, long-term financial growth, but then also market perception of the company at any given moment. Just ask Metastock about how market perception and investor confidence impact share price. But how does this circle back to REITs, you might ask? Well, for one thing, most stock market investors tend to not be real estate investors and vice versa, which ultimately just comes down to a different investor mindset. The real estate market tends to move a lot slower than the stock market does, from individual asset price fluctuations to full-on market shifts, and this pretty much just comes down to the fact that real estate is highly illiquid, which is the complete opposite of the stock market. The thing is, you can't accurately check the value of your house or rental property the same way that you can simply log into your brokerage account and see the exact value of each one of the positions that you're holding, and you also can't buy and sell real estate in a matter of minutes either. That's primarily why the stock market tends to react a lot quicker and harsher to economic news than the real estate market does. Let's remember though that in the eyes of stock market investors, REITs are quite simply a more liquid version of real estate. So it's completely normal that they get impacted by news and rate hikes much quicker than actual physical real estate does in the market. Again, just take a look at Granite REIT's stock chart, and parallel to the growth of their revenues and operating income, the company's financials are growing tremendously, although looming interest rates and recession fears have the company's market capitalization down 30%. Now, that's not to say that physical real estate doesn't also get impacted by interest rates. Of course it does, but the time it takes for higher interest rates to actually impact buyer purchasing power and therefore materially impact the value of real property tends to take several months. For example, here is a chart of real estate values across Canada over the past year, where we can see that values have dropped from an average of around 816,000 to now around 644,000, representing a roughly 21% drop. But this isn't really a fair comparison for most REITs anyways, because REITs invest in commercial grade income generating properties versus this chart taking into account a global picture of most properties across Canada, which tend to be primary residences, and rental properties tend to not get as impacted by interest rates as residential property. So right now, most REIT and residential real estate values are getting absolutely crushed with higher interest rates. There's absolutely no denying that. But whether or not investing in REITs still represents a viable investment option for a stock market investor who wants exposure to real estate in their portfolio is ultimately going to come down to the REIT's financial performance in question, as well as whether or not you believe real estate values will start bouncing back in the next 12 to 24 months. I personally think they will, once inevitably interest rates are going to start coming down once again. The reason why interest rates have been increased dramatically over the past 3 quarters is to fight rampant inflation. There's nothing new there, but the Fed and Bank of Canada don't want to keep interest rates higher than they have to, as this also has massively negative repercussions on the entire economy. Of course, no one ultimately knows when interest rates will in fact start dropping once again. This will be highly beneficial for REIT returns as well as real estate investors returns alike, as lower costs of borrowing will increase investor returns. For now though, if you're still interested in investing into individual REITs such as myself on a very selective basis, focus on companies that are still growing, right? That have quality balance sheets and that are continuously increasing their operating income on a yearly basis. Also in certain facets of real estate that have a brighter future, specifically, in my opinion, industrial properties as well as apartment buildings. This could also very well be a good opportunity to lower your cost basis on some of these individual REITs while also increasing your yield on cost. For example, looking at Granite REIT, this is a company once again that invests in industrial properties such as logistics centers and warehouses. There's going to be an ever increasing demand for these types of rental properties over the next several decades, and this is a company that is off around 30% from the peak that it achieved in early 2022 with a much higher dividend yield as of right now. If you're interested in learning more about how you can start investing in REITs, definitely check out the link down below to my full stock market investing course. It's completely free. I put it over on Skillshare so that you can access that entire course, over 7 hours of content, completely free on a 1-month free trial. Now, additionally, if you need to open up a brokerage account to start investing in some individual REITs, check out both Wealthsimple as well as Questrade. You can open up an account and get some free money for doing so. So thanks a lot for watching today's video. Really hope you enjoyed it. If you did, make sure to drop a like, subscribe to the channel, and with that said, I'll see you in the next one.